जी अली अस्सलाम वालेकुम।
अस्सलाम वालेकुम, क्या हाल है आपका?
How are you?
I'm good, thank you. I just got back to my desk. I was outside for a meeting, so slightly out of breath right now. Sakib Saab, thank you for joining as always, and thank you for writing the report. We're always keen to hear from you and hear your views, and especially in these times, where the market has been extremely, the market and the economic conditions of Pakistan have been extremely volatile, and even volatile from Pakistani standards. So thank you for taking this time. And most of the people in the audience, they all know you. They've read your reports, not just the recent one, but for many years. So with that, over to you. Would love to hear from you how you think Pakistan's economy will pan out, and how do you think what are the challenges and how the government will deal with that?
Thank you, Ali. It's always a pleasure, and a very warm welcome to everyone who's joined us on the webinar. As Ali mentioned, and I'm sure most of you know, that the webinar basically is or will revolve around our quarterly macro view that we produced for Khadim Ali Shah Bukhari, and it was released around 10 days ago. So if you give me a quick second, I'll just share my presentation. I think Ali, you'll need to give me hosting rights.
Yes, I'm just trying to do that. My colleague who is the guy who's the host would have to do that. So guys in the office, if you can hear me, can you please make Sakib Saab the co-host as well, so he can share his presentation? My colleagues are in Karachi and I'm in London, so there's always a delay in the communication with them. But I hope they're listening, and I'll just message them as well.
Yeah, no issues.
Yes. So they're just making you the host. You are the co-host now, so you'll be able to share the presentation.
Okay, great. Thanks.
Thank you.
Right. So I assume all of you can see the screen, the presentation.
Yes.
Excellent. So basically, this report asks a question which Ali just did in the intro, which is that we've had the IMF program, we're back on board, and what now, right? So we'll try to answer this. Broadly, the key themes that that obviously dominate the environment. The first is this is a world of risk. It's whether geopolitics or deteriorating macroeconomic conditions. In terms of the domestic scene, it's uncertain politics. The economy is dominated by flood losses, what will happen to the rupee, whether the recent episode of appreciation, if it continues or if it resumes. It's obviously interrupted for a little, for a day or so now. Whether this will lead to tension with the IMF or a full-blown collision course. And we know that, because of the macroeconomic stabilization policies that are in place, the economy is moving along a certain predefined path. Very quickly, in terms of politics, I think our underlying belief is that the prevailing state of uncertainty is likely to continue. PTI is obviously, in our view, is skirting very dangerously close to a full-blown confrontation with the army. They're right now, it seems, waiting for November and things to sort out with the appointment of either the extension of the current army chief or appointment of a new one, and how things pan out. And there are obviously one of two possible paths post that development. One is that if there is a new army leadership, It pursues a path of accommodation, rapprochement, and early elections, which obviously satisfies PTI, and then it backs down from a path of confrontation. The other is that whether it's a new leadership or an extension of the current one, there's a continuation of the status quo in their policies. There's more pressure on PTI and Imran Khan, and elections are held as scheduled next year, late next year, which is obviously not something which PTI is looking for. We believe the second path is more likely, and therefore the political uncertainty that we are in will probably not just linger on for a few months, but it is likely to intensify. And this will cast a shadow over the economic performance of the government overall, as well as constricting the policy space that they have vis-a-vis following the strictures of the IMF program. So, things are not really going to ease up either for the government or for the economy, in our view. I think I'll just, very quickly go through this slide because all of you are familiar with what's happening in the global economy. I think one thing that I would like to point out is that our underlying assumption, which obviously is open to challenge, that is that the global economy is heading into a severe recession. And primarily, we know that the Eurozone or Europe is in a recession or just about getting there. But what this basically means is that our call is that the US is going to dip into a recession. Now, this could be a brief recession, but it's going to be fairly severe in our view. And our forecasts basically flow from this view. So I'll talk about this a bit later. The rest of it is not really anything which would catch you by surprise. So I'll head straight into our view for Pakistan's external account. Now, I have to say that we took a contrarian view, somewhat contrarian view in our previous quarterly, which was in May, and contrary to what the markets were saying and what bond yields, Pakistan's sovereign bond yields were indicating, and the credit default swaps, etc., we basically felt that Pakistan will not default or will not dip into a default in the short run, even with a delay in the resumption of the stalled IMF program. And it seems that our contrarian view has been vindicated. Now, of course, the pertinent question is what next? And here, no one is saying, even with our view, we are not saying that Pakistan is not skating on thin ice as far as the external account is concerned. It is still in a very, very vulnerable situation, especially in the medium term, on account of the following two things. The first, there is obviously additional pressure generated by the floods, which we'll talk about in the next few slides. I think perhaps this this macro view that we produced for KSB is the first, amongst the first, if not the first, that has some detailed, projections, or at least takes a stab, very preliminary assessment of the impact of the floods on Pakistan's economy. And the second thing in the medium term is that there's elevated external debt repayments, and that will continue to exert pressure on the balance of payments. So by no means, the fact that we've avoided a default by no means means that we are out of the woods. We are not. So if I quickly talk about the impact of recent floods, which we covered in the report, basically, our estimates, the overall broad one of $30 billion losses of thereabouts comes from the government's assessment. And these are preliminary assessments. Obviously, they are subject to change. They were very likely to change. And more firmer assessments will be, as you know, estimates will be available with the damage assessment, which is ongoing, which is being led by the World Bank and by ADB and the UNDP. So once these are available, then we have firmer estimates. But the methodology for putting out the estimates that I have basically comes from satellite imagery and the analysis of that imagery by ICI mod. Now, this is server ICI mod. It's a website basically that deals with assessment of the agriculture in South Asia, and they've put out a detailed assessment of their, what their satellite imagery is saying about the Sindh situation. So a key input was this, and then of course I triangulated that with other inputs, not just from the field but also from the government, and I've arrived at the worst case scenario here. This is not the base case. This is the worst case simply because, and mind you, this seems to be turning into the base case simply because the worst case scenario that I assumed had Sindh missing the plantation window for wheat in Sindh. So no sowing of wheat in the affected areas in Sindh, which means potentially a loss of 4 million tons of wheat for Pakistan, which will then have to be imported. Right, so this is an incremental 4 million tons that will have to be imported. So this is based on that, and I think this worst case scenario is turning out into a base case scenario, the way things stand. And the reason Sindh is very likely to miss the sowing or the planting season for window for wheat is simply because the water has not drained in Sindh. Even in areas where it has drained, the conditions are not right for plantation or for preparing the fields. And finally, a very important element is that a large part of the seed stock that is used for plantation has been lost initially earlier in the rains and then in the flooding. So I think put all these together, personally, I think that the worst case scenario is now the base case scenario. So these are the potential losses for cotton, for rice, sugarcane, wheat, minor crops, and livestock. Now, they all translate into shaving off around 1.6% of GDP growth for FY23 in direct terms. And if you add the knock-on effect or how this agriculture or crop situation feeds into the services sector primarily, and then a part of it into manufacturing, then potential losses are as high as 2.1% in FY23, right? So in our view, this implies that FY23 real GDP growth is likely to be in the region of 1.5 to 2%. 2% is really the upper bound as far as we're concerned. And when we put this out in early October, then a few days later, and in fact, just 2 days ago, or 3 or 4 days ago, the World Bank has also put out its estimate, preliminary estimate of growth for FY23 in Pakistan, and it's 2%. So it's moving towards our estimate of GDP growth. And clearly, Pakistan is no longer a single crop economy the way it used to be. When I first produced this correlation back in the 1990s, the correlation was as high as 60%. Now it's come down to about 20% or thereabouts. It's still significant, but not as substantial as it used to be. Now, the overall estimated impact on the balance of payments is going to be, at current prices, roughly about $5 billion. So it's split into two. One, our import requirement, and two, the loss of export revenue, and add the two together, it's about $4.9 billion at current prices. Now, this is, of course, once again, assuming that wheat will need to be imported, it will not be planted in Sindh. Secondly, it assumes that our textile industry does not head into recessionary conditions in its export markets, and its cotton import requirement remains at as per the base case scenario, which of course is maybe it may not happen. So this is once again the worst case scenario, $5 billion of additional impact on the balance of payments in FY23 because of the flooding. Now, factor this into the current account balance and Pakistan's gross external financing requirements for FY23 and then FY24. A whole lot of numbers here. So I'll just make it easier for you by highlighting the numbers that you should be looking at. Current account balance, in our view, for FY23 is going to be now around $11.5 billion. This is because of the flood impact. If you recall, in May, we were talking about something like around $5 to $6 billion because of stabilization policies. And now, the stabilization policies have not been as tight, both the fiscal and monetary, as we thought they would be. So that's one impact. And secondly, the impact of $5 billion of traditional imports. And thirdly, exports and remittances are now softer than we had assumed in May. So this flows into roughly a $12 billion current account balance. And the key thing is the bottom line here. If you look at the last number, which is highlighted, change in FX reserves, SPP. And here the key thing is, even with the IMF purchases from the IMF, the debt relief, exceptional financing, etc., that we've assumed, FX reserve accumulation is only about $2 billion. So really, we are skating on thin ice, and we need a tighter policy framework, or we need, the collapse of commodity prices, or the worst case scenario that we've assumed for floods not to pan out. So, all that will help in reserve accumulation. Then if we move to FY24, the key numbers once again there is we expect the current account balance to blow up to about $15 billion. And the reason for that is, I'll take you through my assumption slide a bit later. But the main reason is that we expect electoral politics to play out in the first half of FY24, and we don't expect the incumbent government. We expect them to basically, from about March, April next year, 2024, we expect them to move into election cycle, and that will lead to deterioration of the balance of payments. And of course, this is completely unsustainable in terms of our FX reserves, and therefore something will have to give, and that will have to be a very fast-track IMF program right after the elections. So that's the only thing that can save Pakistan in FY24. So these are the major projections. Now, if you notice, the first assumption, is based on oil, sort of tumbling to $75 average in FY23 and $60 a barrel in FY24. Now, this is clearly a very recessionary scenario. Like I said, we've taken a position now, and these assumptions were made before the OPEC plus oil cuts, output cuts. So clearly, this assumption is under some degree of risk. We'll talk about that a bit later. We'll also talk about the political noise subsiding. Now, that's a key assumption we've made, and this may not pan out. Now, even though we've spoken about PTI, not getting what it seems, what it's expecting post-November, we've still assumed a fairly charitable scenario where we do not head into a full-blown, a PTI on the street scenario. Now, this is, of course, and if I come to these three assumptions, the first three assumptions, they're all quite risky assumptions, I must admit. So we may have to review these in our next quarterly. But for now, right now, I'm using these are flowing into the base case assumptions. So this is basically the medium-term outlook, the external debt repayments and gross external financing requirements. We've talked about that a bit more in the report. Now, what does this mean for the rupee? So we had said that we expect a significant continuing pressure on the rupee in FY23, despite the current phase. So when we wrote this, Darsa had just landed and had started choreographing the appreciation of the rupee. Now we think that post IMF meetings and the World Bank meetings, Darsa will probably resume that, but it's not going to last too long in our view. There's a whole host of reasons why we think this is likely. So I think most of you know the reasons for the pressure on the rupee so far. I'll just skip this very quickly and come to the outlook for the medium term. So there's some structural factors at play as well, and I think it's not just a small and undiversified export base. It's also the last 2 years have seen a very sharp rise in the monetary base. So reserve money growth has been very sharp. It's been about 22% since July 2020. So that's quite sharp, and obviously that's playing out into the weakness of the rupee as well. So we think that despite the managed ongoing appreciation, which has stalled now briefly, the rupee is on weak footing from here on, unless international commodity prices really collapse in a big way. So that's one factor which will support the rupee. The other thing is that the government moves into a tighter and a more robust policy framework, either fiscal or monetary. That will help. Third is that the political uncertainty does not play out, because the political uncertainty will also feed into a weakness of the rupee. Now, putting all these considerations together, for us in the base case, it suggests that the rupee recently, since Darsa has come into the picture, has been swimming against the tide, and this is not sustainable. So it may happen for a few weeks more at the maximum, but the trend of weakness is likely to resume at some stage beyond that. Now, in terms of inflation and the interest rates outlook, the inflation, as you know, in September has trended down a bit, even though food inflation has gone up. And so has core inflation. And food inflation now is accounting once again for roughly half, in fact, just about half of the headline CPI in September. And in August, this was about less than 40%. I think one thing which State Bank is looking at, obviously with some degree of concern, is the uptick in core inflation. Core inflation has almost doubled since February. It's now crossed 14% and this is non-food, non-energy for urban. But the State Bank is following a reactive and cautious policy path, which I've been saying for, as you know, you've heard me saying this for many, many months now. And now I think something has been confirmed for me, which I think you've obviously, many of you, the market participants have probably noticed as well, that it seems that the State Bank has rebased its monetary policy response function to core inflation from headline inflation. I think that's the only thing that can justify the policy response function of the State Bank at this point in time. Now, if that is the case, and obviously the State Bank is going to change its monetary policy path based on two things happening. One, if core inflation continues to tick up, so that's obviously going to change, be a driver for the change in monetary policy from here on, or if the State Bank's own assessment of the inflation outlook changes for the worse. Right now, it's fairly benign, as you all know, and it seems to be panning out because the international commodity outlook is fairly benign. The rupee is now not weakening. There are no disorderly market conditions. It's appreciated and it seems to be stabilizing. So the assessment is fairly positive or fairly benign, the inflation outlook, as far as SPP is concerned. So the only thing that's really going to be a big driver for them, I think, is going to be how core inflation pans out from here on. So that's something that you may need to look at carefully. So in summary, our main takeaways have been that Pakistan will continue to avoid defaulting. It'll remain current in our view during FY23 on its maturing sovereign external debt obligations. However, the external account is far from comfortable, especially in FY24. The country's macro challenges have been amplified by the super floods. GDP growth is going to be at least 1.5% lower, around 1.5 to 2% is going to be the headline GDP growth for FY23. And this is based on obviously the worst case scenario, which now we think is moving towards the base case scenario. And MEI believes that the flooding has added around $5 billion for burden to our balance of payments in FY23. In gross terms, obviously, it's going to be funded to some extent through debt refinancing or through exceptional financing or debt restructuring. We also believe that the floods obviously have led to food inflation remaining elevated, and food shortages are going to be the main driver for that. But however, we do not expect SPP to react to this, because SPP obviously thinks that any food inflation that's going to come because of the floods is going to be transitory and it's going to be supply induced. So they don't have to really react to it. That's their policy response function. However, in terms of the rupee, I think one driver for the pressure that will come on the rupee for the next few months is that substantial payment arrears have been accumulated since May in terms of deferred import letters of credit, profit and dividend repatriation has been stopped, other outflows have been stopped, have been blocked. Now these will gradually, they'll need to be unwound. This is what the IMF position is over the course of the next few months, and that will obviously feed into additional pressure on the rupee. So, so this is our view on the rupee. Political risks we've mentioned, they'll continue to remain elevated. We think in the short run, Pakistan's external account remains largely funded, though not entirely. In the medium term, I've said this in the past as well, we think that the mismatch between the external debt service requirements and repayment capacity is fairly large, and this will require an IMF-led debt reprofiling. Now, these are the main risks to our forecast. As you can imagine, we've assumed certain things. If they do not pan out, clearly that's going to move our forecasts around. So I'll stop here. Thank you. Basically, that's it from us. And any questions, is something that.
Thank you, Sakib Saab, for this presentation. And this is very interesting. And I suppose it's slightly more positive than the fears which are there, which is that, Pakistan could, like the markets are still pricing in a default scenario. You mentioned that over the medium term, some kind of IMF-led restructuring will be imminent. A, what happens in such scenarios? And B, what do you think is the likelihood of debtors agreeing to structure such a thing? And then there is optimism that given the response of international communities to Pakistan's floods, that there would be some kind of either debt forgiveness or a freezing of interest payment. Then how do you see all of that panning out and impacting Pakistan's economy?
So, very important question, Ali. And so we've been writing since May, as you know, that we've been writing that, this is quite, for us, it's almost, something that will happen. However, when we wrote this and we, took this out, this publication on October 3rd, subsequently, Dar Saab has been giving interviews finally, and he ruled out in one of his interviews a few days ago before leaving for the IMF World Bank meetings, he ruled out going to the Paris Club. So prior to that, the indications were that the creditors have no issues, especially post-floods. As you know, the UNDP put out a policy note as well, saying that they think that this is the position Pakistan should take, and that note basically was circulated in the UN system and was considered to be the UN position. And once that happens, and pretty much, I mean, you can expect the IMF and the World Bank being part of the UN system as well, to take a lead from that. Now, so the issue is, I don't think there was any hesitancy on the part of the creditors. I think now Mr. Dar, if for the people, has actually thrown a spanner in the works by ruling it out. So, so I'm a little surprised, because I would think that this is an opportunity for Pakistan to use, the pretext of the floods. Even without the floods, I've been saying this for a year or so now, that Pakistan's external debt profile is such that it's pretty much unserviceable for Pakistan, given our current export, sort of levels, etc. Therefore, I think this is a great opportunity for Pakistan to latch on to the Paris Club. And how it works, basically, in the past, the Paris Club, the IMF is actually organized not just a Paris Club bilateral rescheduling, but also London Club creditors. So all commercial creditors, they've actually, in a sense, forced Pakistan to do, both Paris Club and London Club, as well as in '99, if I'm not mistaken, they experimented with Ecuador and Pakistan being two countries that had outstanding bonds, and they wanted to bail in private bondholders as well. So this was the Anne Kruger, formula at the IMF. Now I think that didn't really pan out too well for countries like Pakistan and Ecuador. And now I think what will happen is that the IMF, to my understanding, and we've got people like Raza's there, I noticed, other people and yourself and many others, I'm sure, who will also deal with the IMF more closely than I do, would also bear this out, that the IMF now is probably looking at Paris Club and not really London Club, or bailing in private bondholders as well. They're not as keen as they were in the 1990s. They've moved on from that, and rightfully so. So I think this will probably involve, if it does, at some stage when Pakistan agrees, it will involve the Paris Club bilateral creditors, and it will have to involve the Chinese, obviously the non-Paris Club bilateral creditors as well. And I think that will be key. The only thing that could potentially be a holdout to a deal would be how the non-Paris Club creditors, especially the Chinese, react to this. So that's the way to
well, thank you for that. And I have two more questions, and then we'll open up for the audience. And for the audience, please, I do notice some raised hands, but it would be great if you write your question on chat so I can read it. It just becomes more efficient. So Sakib, you mentioned Chinese creditors. Politically, what do you think? Then we haven't heard much from the Chinese in terms of their involvement in Pakistan or their response to Pakistani requests, at least publicly, and perhaps that's how China operates. Do you have any color on what's China's view on both relationship with Pakistan and their involvement in Pakistan going forward?
No, to be honest, I don't have a current flavor, because, as you know, the post-April 7th, things have undergone a sea change in Pakistan's geopolitical alignment. So I'm really not sure how the Chinese are viewing Pakistan now, and or how they would view a potential request for Paris Club and a non-Paris Club rescheduling. I think it's a bit early at this stage, and maybe one reason Darsa ruled it out is because he understands that the Chinese are not keen on this. I'm not sure, so I really can't answer this at this point in time.
No, thank you. And that's exactly my fear, that, I have no visibility on that, and like in terms of how Chinese would react to Pakistan. The second question is, you and then Ishaq Dar as finance minister, and you've written a lot. I think you coined the term Daro economics in your articles for the Dawn back in the previous regime. And now with Pakistan in an IMF program, with State Bank required to be independent, but having now a strong finance minister, do you think things will move smoothly in terms of like uh, the modus operandi, or do you think there could be a risk? And how would IMF view the policies which you think Isagdar is likely to take?
First, I also thought I'd coined the term Darnomics, and I was very happy with that until I did a Google search about 2 weeks ago, and unfortunately, I realized that Reuters had used this term in 2008.
Okay.
So, so for some reason, I don't know why, in 2008 or 9 or something like that. So they beat me to it, and maybe so subconsciously I actually took it from there. So I have to give them credit for it. I think the key thing is that if there has been a geopolitical realignment of Pakistan and the US post April 7th, and this dispensation and DARSAB are a result of that. If you take this view, then I think it's quite likely that the IMF will show some forbearance to DARSAB's policies, right? And I think so it all depends to what extent the events that took place in Pakistan, in April, were a result of regime change. So I think personally, I think given my sort of understanding of things, I think this government will get leeway, some leeway, maybe not a lot, from the IMF, but not to the extent of really sort of reinstating Darnomics from 2015, 16, 17, where you have a pegged exchange rate, an overvalued exchange rate, because as you know, a key element, in fact, the most important element of stability in this current program with the IMF is the market determined exchange rate. So if DARSAB throws that openly out of the window, I think there will be a problem. The executive board will have a problem. The staff may not have it, the management may not have it, but the executive board certainly will have it. So I think that will have to be managed in some way. So I think there are limits to what DARSAB can do. And I think the strategy is going to be what PTI was following to some extent as well. The strategy, the way I read it, I could be wrong, is PMLN is going to remain largely within the strictures of the IMF program till around March. And then it's going to ditch the program. Or it's going to not ditch it completely, but it's going to start expanding its latitude, policy latitude, and try to remain within the program, but follow its own policies and try to give prepare for the elections. And the IMF may have no leeway other than may have no choice other than just to ignore the widening latitude DARSAB is taking on board, and continue with the program and not ditch Pakistan by June 2023. So I think that seems to be the PMLN political strategy.
Thank you for that. Just moving now to the questions from audience. Satish Balani is asking, sorry, just 1 second, the question moved. With rising interest rates globally, will any government have capacity to run current account deficit?
I think obviously it's going to be difficult for Pakistan, for countries like Pakistan, but unfortunately, like I said, Pakistan is already not running a tight or a tight enough policy framework, and it'll have to be. You're absolutely right. I mean, we'll have to squeeze. Ideally, we'll have to squeeze the current account deficit to around $4 to $5 billion. I mean, that's the only thing that is financing of which is sustainable. But Pakistan is not going to be doing that, unfortunately. And I think right now in FY23, we'll get away with it because of the financing, exceptional financing we're going to get because of the floods. And if Dar Saab is sensible, we can get away with it if he talks about actually starts moving the needle on the debt refinancing, the debt restructuring. So we can get away with it in FY23, but not FY24.
Got it. So I think the next question, you have already answered it partially, but I'll still read it. Mohammed Sharif Saab is asking that given the situation, don't you think the current or the new government will go for reprofiling, even as you said that Dar has ruled it out, but our politicians are used to U-turns?
They are absolutely, and so you know, I mean, I think the problem with Dar Saab is that he has these, vanity projects. So one of them is the exchange rate, as we know. Now, if he said he'll bring it to 180, I think for a brief time he will bring it to, or try to bring it to 180. And if he said I'm ruling out Paris Club, debt reprofiling simply because this hurts Pakistan's image, then I think I know I've worked with Dar Saab in a sense as part of his Economic Advisory Council as well. I think unfortunately he probably means it and he's going to stick to it, which is not in Pakistan's interest. So right now, I think this is my working assumption that he's going to stick to it.
Thank you. Raza Anam from MCB Arif Habib is asking that can you give a breakup of the $26.6 billion in bilateral and multilateral flows which you're assuming?
Yeah, so I'll have to look at my sheet, but you know, it's obviously a large part of it is the World Bank, ADB, but it includes JICA, and it includes the Saudis, it includes Islamic Development Bank, it includes oil facilities, it includes, so it's the whole spectrum. And generally, it's not too different from what we get. Roughly, we get something like 18, 19 to about $25 billion, or to about 21, $22 billion each year. So it's just, it's part of it is a tweak because of the flooding, assistance that we get because of the flooding. So it's all adding all of that together, including rollovers, by the way. So this includes the Saudi rollover and the Chinese rollover. It includes fresh money from AIIB, the China Exim Bank, partially, not too much. I don't have any sort of specific details. I've made assumptions here, but a large part of that actually is I've triangulated from the IMF country reports as well. So they seem to triangulate pretty much similarly.
Sakib sir, what I find very ironic and or rather scary is and concerning is that if you notice, like all our discussion and Pakistan's economic issues, like now they're only focused on debt and whether on avoiding default and getting those debt funding either in rollovers or in terms of new loans and renegotiating of old loans. So the conversations around investment and the conversations around privatizations and the conversations around FDIs, there seems to be no space for any of those things. So, and do you think that this will continue this situation will continue on until there's some kind of restructuring of debt, as you said, that there should be, and Pakistan should go for that, because my fear is that if this elephant stays in the room, then we might be stuck here for a long time until it's resolved. Nobody will think about making long-term investment in Pakistan.
I actually fully agree with you, Ali. I think that's a key issue. So obviously there are a number of uncertainties. One of them is the domestic political situation that's putting off investors. Of course, there's the regional and geopolitical and global economic situation as well. So that's obviously putting off privatization and capital flows to developing countries, emerging markets. But there's very specific concern when people do look at Pakistan and they run the numbers, they will obviously would want to know how the external account is going to be financed. And for that, they need visibility. And that visibility can only come from sorting out the Paris Club rescheduling. You're absolutely right.
Moving to the next question, I think you've already again talked about it. Asim is asking, will the international donors be comfortable with providing debt relief or aid to Pakistan under Ishaq Dar, knowing that what his policy inclinations are, and the 6 to 8 months window in which PMLN would most likely attempt to take populist measures? So given what you just said, that they will take populist measures, will we still get money?
I think, in a sense, we are lucky, Pakistan. We are a sort of accident-prone nation, but somehow the accidents, work in our favor as well. So it was the Afghan war, and then it's, going back actually to the Korea War. Pakistan has been benefiting from geopolitical accidents and catastrophes, and now it's the floods. So whether they agree with the policies or not, I think the flooding is going to really make the international community swing into action for Pakistan.
Thank you. There's a question from Sindh Bank that State Bank was a bit tight-lipped about forward view on policy rate in the recent MPS monetary policy statement, which was always there in the past. It has given market a hope that the State Bank might cut policy rate in November 2022 or in January 2023 based on slightly positive interest rates when considering core inflation. What's your view on this?
No, I fully agree. In fact, my view is, so for the view for this past monetary policy was that they're going to hold it. And now my view is for the next one, given that inflation is likely to follow a path of disinflation, it's going to come down. And the reason it's going to come down is very important as well. I think partly in the September numbers, we did not see the pass-through from petroleum price cut. And, so we saw the electricity adjustments, FC adjustments flowing through into the inflation number, but not the petroleum price cut. That's going to flow through in October numbers. And very frankly, the numbers I fear are going to be manipulated from here, the inflation numbers. There is a feel-good factor that's going to be generated, both with the rupee and with the inflation numbers. And therefore, I think the State Bank is very likely to cut in the next MPS, in my view.
We still have 10 minutes, and so if you have more questions, please do ask those. And in the meanwhile, Raza Aga, you want a question? Please go ahead. Let me unmute you. 1 second, I need to find you. Yes, you're unmute, so Raza Bhai, please go ahead. Oh, you are still on mute. Can you please, can the KSB host make Raza Aga unmute? Surprisingly, I can't seem to do that, but I'll ask the next question from Asim. He's asking, what is driving the current account estimate in 2024? And in the meanwhile, I'll just try to unmute Raza.
Yeah, so basically, like I said, it's the belief, I could be wrong, but my belief, which is underlying my base case, that Dar Saab and PMLN will start preparing for, or will go into election mode by March or April latest 2024, and follow policies that are going to lead to a widening of the trade balance. And in any case, exports are going to remain subdued. Remittances seem to be soft. The world conditions, the regional conditions are such that I think our foreign exchange earnings are going to remain soft. But the import side may actually start picking up because of the overvalued exchange rate and the other policies, slightly stimulatory policies, which Dar Saab may pursue from March onwards.
Thank you. There's a question from Hassan Raza. Is asking that what are we missing that what the international market is looking, that the bond yields are indicating that Pakistan has defaulted?
I think the same thing, Raza, which they missed from May onwards. I was very categorical that Pakistan will not default in May, June, July. I've been saying that. The markets have been saying otherwise. So I think they're still getting it wrong. I mean, when you look at the numbers, obviously sitting outside, when you look at the headline numbers, it does seem very scary. But I think when you're on the ground and you do your, sort of the more nuanced calculations, I think Pakistan will escape the default in FY23.
I see a hand raised by Sindbank. Do you want to go ahead and ask the question yourself? You can unmute yourself. Yeah, please.
Yeah. Can you hear me?
We can, yes.
Walaikum salam. Thank you, Sakib, for such an insightful view into the economy and the political situation in Pakistan. I have a question. What happens beyond calendar year 2023? Let's suppose that we go down this path and there are elections on the time next year. So we have always seen that there are always fiscal slippages, and we are always seen that current account deficit also deteriorates while we are into the election. Though Rupee may stabilize and though interest rates may decline for the time being, but how are we looking at economic situation beyond election, beyond September 2023, and for next 2 to 3 years? How do you see Pakistan's economic and political situation evolving around further? Thank you.
Right. Thank you for your question. So obviously, I can't say about the politics. I think it would be a very foolish person who would try to say something what's going to happen tomorrow in politics in Pakistan. But in terms of the economics, I've already actually showed in the slide on. So FY24 is a blowout year. Without the 24th IMF program, Pakistan will head towards a default in FY24. So we will require, whichever government comes in, will need to fast track an IMF negotiation with the IMF for an IMF program. That's a scenario that I see.
Thank you. The question from Mohammad Asim, he's asking, how do you see remittances and Roshan Digital, the flows which we are getting from Roshan Digital going forward? Do you think they can dip or?
So obviously Roshan Digital is a bit, difficult to say, but remittances certainly are dipping. They are becoming soft, and I think they will continue to soften a bit. Roshan Digital account numbers have also softened. So the inflows have, they seem to have peaked. And I think given the fact that the RDAs were based, inflows into RDAs have been based, not just on the returns that non-resident Pakistanis are getting, but also, their perceptions about political stability. And I think that has been questioned quite a bit. I think that's taken a knock, that confidence. And therefore, I think the RDAs are also confidence sensitive flows. They're not just interest rate sensitive. Given that view, I think they will soften. That's my personal view. I think they will soften going forward.
Thank you. Zahidullah Khan is asking, where could you see the rupee dollar parity by the time we will be entering into the new IMF program post elections?
Sorry, can you just repeat that again?
So the exchange rate, where will the rupee dollar exchange rate be when we are entering into the next IMF program after the next elections? So exchange rate outlook in next year.
So obviously with a financing requirement of about $42 billion, you can imagine a gross external financing requirement and a net drawdown of reserves without additional financing of about $14 to $15 billion. You can imagine it's going to be a replay of 2018. It's going to be a replay of 2022. So I haven't done the projections, but I can just tell you very broadly, you're still talking once again about a 30%, 25, 30% fall in the value of the rupee easily.
Wow, that's very scary. So like, within another 12 months, there could be another 30% step down in the exchange rate. Very sobering. They're almost taking the breath out of me. The next question, we have time for like a few questions more, 2 questions perhaps. Abdul Rafi Iqbal is asking that, do you think we can all somehow encourage and maybe convince the political structure for once to consider taking proactive measures which are focused towards a slow, sustainable growth model with certain factors remaining the same? For example, export competitiveness to remain and high percentage of luxury good imports.
Now, I assume Rafi, or the person, the gentleman asking the question is Karachi based, right? Because people in Karachi tend to view policymakers sitting in Islamabad through a slightly more rose-tinted sense, lens. They tend to think that they're more amenable to reason and logic, whereas those of us who have interacted with them sitting much closer here in Islamabad for the last 20, 25 years know that is not the case anymore. So I'm not hopeful, to be honest.
And there's another question from Satish at the follow-up, and he's saying, is there a risk that the political government might miscalculate current account slippage and overdo the stimulus? And then there does seem to be a bit of bravado or a bit of more overconfidence with Ishaq Dar, as in his body language is indicating. So is there a risk on that side?
No, clearly. So if you go back to the slide that I presented, I mean, that risk is being manifested in a current account deficit of 14, $15 billion and a gross external financing requirement of $41 billion. That risk is pretty much there in the numbers. Absolutely.
So with the potential risk for 30% depreciation within 12 months, and then that doesn't really leave much hope for the rest for us as investors, right? Like, so what would you recommend for investors to do?
So first, I hope this is like Chatham House rules in the sense. I know, I mean, a lot of you are in the markets. In fact, all of you are market participants. So this is a market talk in many senses. But what I meant was, I mean, please don't put on your post on your Facebook tonight that Sakib Sherani is saying that the rupee will depreciate 30% next year. I'm not saying, I'm saying that's the worst case scenario. It's a likely scenario, but I mean, there could be corrective actions. Darsa could see light. He could ditch Darnomics. I mean, many things could happen, or we could get dollops of financing because we've been good boys, geopolitically. So anything could happen. But I'm saying if none of these things happen, then that's the worst case scenario.
Yes, as in but as you said, the worst case is the base case, because your estimates show that Pakistan will need to restructure the debt, and essentially the point is that when we go for such kind of restructuring, there will be an exchange rate adjustment which will be linked with that.
Certainly, we'll need an IMF program, and that's a prerequisite for the negotiations. And then the negotiation starts. So when we have an IMF program, then Darnomics will go out of the window, because I mean, if let's say Darsa has managed to bring the rupee 280, or it's creeping back up to 200 or whatever, clearly the underlying fundamental value is much higher than that. It's around 260, 270 or whatever. The IMF will make sure that we first bring it back to the fundamental equilibrium, and then things proceed from there. Yeah, so you're right.
And when you say fundamental equilibrium, essentially you're implying that at a level where the current account deficit gets to a level which is sustainable.
Yeah, absolutely. Yeah. So around, let's say, about 2.5% of GDP.
So I know we have just 1 minute left. So just a final question from my side. When does this current IMF program end, and by when will the government need to start the negotiations for the next program?
So this one has been extended, as you know, till June 2023. And I think, was it June or September? Maybe it was ending in June and it's been moved forward to September. Something to that effect, but somewhere around. So the problem is that timing is quite bad because the IMF cannot start negotiating with the government in June simply because there are going to be elections held in September or October. They'll have to wait for the elections, and that discussion, then negotiations will start, in November, October, November, or December at the earliest. So that period is going to be fairly hairy for Pakistan once again.
Yes, because that's exactly my fear, that that we saw it this time as well, that there was a economic transition and political transition at the same time, and that caused all kinds of trouble. And it seems as if that from a timing perspective, we might see a repeat of that in even worse conditions, especially if the global economy also happens to be in a recession next year.
Absolutely, you're right.
Thank you, Sakib Saab, for your time. This was, as always, extremely insightful. And I'm sure that all of us have learned a lot and have a lot to take away from it. Thank you for your time.
Pleasure. Good afternoon.
Hafiz.